Okay, welcome back. Next, let's look at the balance sheet method. You can see I'm using the same worksheet to work from, and I'm just going to modify a few things. And the reason this is called the balance sheet method is because what we're really doing here is we're looking at our receivables to come up with our allowance for doubtful accounts. With the income statement method, what we did is we started from sales times some percentage, and that gave us our number for the allowance for doubtful accounts. And that's why it's called the income sheet method, or the income statement method, because you're starting with an item from the income statement, sales. Okay, the balance sheet method, like I said, is starting from receivables, which is why it's called the balance sheet method. There's two different ways you could look at this. You could look at receivables, your total amount of receivables that you have, and multiply that amount times some percentage to come up with the allowance for doubtful accounts, okay? So that would be simple. If you had receivables of $1 million, you decided 1% of those was typically uncollectible, then you'd have a $10,000 allowance for doubtful accounts. Wonderful, okay? Nothing really complicated there. The one I want to talk a little bit more about is an aging analysis. All right, and the way we look at that is what we're looking at is we're really looking at how old a receivable is. If you've ever in the past gotten a bill and seen on the statement that the bill is currently due, or the bill is 0 to 30 days overdue, or 30 to 60, 60 to 90, 90 and over, okay, what they're doing basically is they're putting the receivables into buckets based on how old they are. And that is really what we're looking at as far as the aging analysis. So what that looks like, okay, this is what an aging analysis looks like. So an aging analysis, like I said, is bucketing your receivables. So if you have $58,000 in receivables that are currently due, you're estimating that approximately 2% of those people are not going to pay you. All right. If you've got receivables that are 31 to 60 days overdue, you've got $8,930 worth of receivables that fall into that bucket. You're estimating 20% of those people are not going to pay you. And if you've got receivables that are over 90 days past due, you've got $3,200 worth of those receivables, and you're estimating that 50% of those people are not going to pay you. Now, as you can see, the numbers are getting higher because the chances of you not getting paid when you have a receivable that is more than 3 months old is getting pretty high, which is where you come out with your total amount of accounts receivable in this problem is $88,000. And you're estimating of that $88,000, $6,288 worth of receivables are not going to get paid. Okay, so let's throw those numbers into our PowerPoint here. Into our Paint here. Okay, so let's say we just decided that the balance sheet method, we looked at an aging analysis, and we just calculated that $6,288 is going to be the amount of receivables that I'm not going to get paid. Okay, so there you go. It's as simple as creating that amount, $6,288 in there. Okay, and making my allowance for doubtful accounts, $6,288. Okay, all of the rest, the good news is all the rest of the journal entries would stay the same. You would have allowance for doubtful accounts as you start using it up. You'd reduce the receivables and so on and so forth. Okay, nothing in here would change. The only thing that changes between the balance sheet method and the income statement method, well, the only things as far as the journal entries go that change is going to be how you calculate these amounts. That's it. So if you understand the allowance method, if you understand the journal entries behind the income statement method, then you understand the journal entries for the balance sheet method. Like I said, the only change is calculating these amounts right here. Okay, there's one other thing in the calculation of these amounts that you need to take into account as a factor. Let's say that we did decide that $6,288 was the correct number to use. Okay, we did an aging analysis and that is the correct number. With the balance sheet method, what we're saying is we're saying that $6,288 is going to be our number for the allowance for doubtful accounts. Okay, $6,288. Now the allowance for doubtful accounts, because it's tied to receivables here, is a balance sheet account, which means it rolls forward from year to year. So there could be a balance that's in there from last year that didn't get used. Let's just say, for argument's sake, that last year you had an extra $100 of allowance that didn't get used. Now if that's the case, you had $100 in there, but you know based on this right here that you want $6,288 to be the balance in your allowance for doubtful accounts account, then what you need to do is you need to figure out what will the journal entry be here to make that happen. Well, the journal entry here would be to 6188 to make that happen. Oops, I don't want to get rid of my lines here. Yikes. Hang on. Undo. Oh, it doesn't work that way. All right. Well, you get the idea here. Let me try drawing a line to make it at least a little bit clean. So you'd have $100 in here that may have rolled forward from last year, plus 6188 would give you the balance that you want of 6288, which means that these guys would change right here. They would also be 6188 and, too far, 6188. Okay? So with the balance sheet method, you have to care what was in there to begin with. All right? Now, there could be the occasion, that's pretty much it for the main discussion on this, but there could be the occasion that maybe instead of, let me wipe this whole thing out here. Oops, that didn't work. Okay, I'm wiping this whole thing out. Let's say that 6288 is still our number. Okay, I'll go back to this problem here. This problem throws a little bit of an interesting twist into it. What it tells us is the allowance for doubtful accounts currently has a $210, here you go, debit balance in it. Well, let's put that $210 in here as a debit balance then. Here's our $210 debit balance. The thing is I still want 6288 to be my final number here. All right? Well, to make this happen, you have to calculate what amount would have to go in here as a credit to leave you a 6288 as the final credit balance. Well, if you do this, the number is going to be 6498. Okay? So you'd have 210, well, 6498 minus 210 would then give you your 6288. So your journal entry then would be for 6498. I'm getting a little off center here, but you get the idea. 6498. Okay? Again, all the journal entries stay the same. The allowance method, the journal entries stay the same. It's all about the difference is how you calculate this amount. So if you're using the balance sheet method, then you do care what's in there in the allowance for doubtful accounts before you begin. If you're using just the income statement method, then you're simply taking a percentage of sales and multiplying that to come out to your allowance for doubtful accounts number. You don't care in the income statement method if there are numbers in there from previous years. Okay? So you had this $210 balance in here, but your income statement method calculation said it would be $30,000 allowance for doubtful accounts, then that's what you wanted. Then you would just add in the new number here, and whatever the end balance is whatever the end balance is, which in this case would be what, $29,790. I hope I did that right. But the point is, for the income statement method, I don't have to care what's sitting in here. I just take a percentage of sales. Whereas the balance sheet method, I do have to take what's in here, and I have to take it into account in my calculations. Okay, so that's pretty much the main part of the receivables, of accounts receivable. The next thing we're going to talk about just briefly is going to be notes receivables.